The number in this title is the first trap in the entire retirement debate. There is no single, universally agreed $94 trillion pension shortfall that every institution uses. But the honest version is not more comforting. It is worse, because serious estimates are all gigantic even when they disagree. One major World Economic Forum and Mercer estimate put the current global retirement savings gap at about $70 trillion and projected it could explode to roughly $400 trillion by 2050. The same research projected a $224 trillion gap by 2050 across just 6 major pension systems: the United States, the United Kingdom, Japan, the Netherlands, Canada, and Australia. A separate insurance sector estimate came in much lower, near $41 trillion, because it measured the problem differently. So the precise headline number is arguable. The direction of travel is not. Every credible projection points the same way. The math behind retirement is getting harder, not easier. That matters because most people still imagine retirement using an old 20th century picture. You work for decades. You stop in your early or mid-60s, the mortgage is paid, a pension or social security check arrives, and the rest is about comfort, not survival. That picture was built on a very specific balance. You needed a large working age population, a manageable number of retirees, steady contributions, decent investment returns, and a retirement period that did not last forever. Rich countries are now losing that balance from several directions at once. Birth rates have fallen. People are living longer. Many workers do not save enough on their own. And voters usually hate benefit cuts, which means politicians postpone hard fixes until the bill gets larger. The bluntest way to see the problem is the worker-to-retiree ratio. According to OECD projections released in 2025, there will be 52 people aged 65 and over for every 100 people aged 20 to 64 across the OECD by 2050. That ratio was 33 in 2025 and just 22 in 2000. Think about what that means in ordinary language. The pool of workers supporting each retiree is shrinking fast. In a pay-as-you-go system, current workers fund current retirees. If the number of workers per retiree falls, the system does not magically rebalance itself. Someone takes the hit. Payroll taxes go up, benefits get trimmed, retirement ages move later, governments borrow more. Usually the real answer is a mixture of all four. This is why the phrase "your generation will never retire" hits such a nerve. It does not usually mean every single person will work until the day they die. It means the old retirement package becomes harder to reach and harder to trust. A lot more people will delay retirement. A lot more people will phase into part-time work instead of stopping cleanly. A lot more families will support aging parents and adult children at the same time. And a lot more retirees will discover that retirement still exists on paper while feeling very different in real life from the version their parents expected. The United States gives one of the clearest official warnings because the numbers are so specific. In the 2026 Social Security Trustees Report, the combined old age and disability trust funds were projected to be depleted in 2034, with 83% of scheduled benefits payable at that point if lawmakers do nothing. The old age fund alone was projected to be depleted in late 2032, with 78% of scheduled benefits payable then. Notice what that does and does not mean. It does not mean Social Security vanishes in the 2030s. It means the system is officially projected to pay less than promised, unless Congress changes the rules. For younger workers, that is the real betrayal. They are paying payroll taxes into a system that has already told them, in formal trustee language, that full promises are not fully funded. The scale of the system makes the warning harder to dismiss. In 2025, Social Security paid about $160 trillion in benefits to 70 million beneficiaries, while about 18.5 million workers had earnings covered by the system. That is not a fringe program with a tiny gap. That is one of the central pillars of old age income in the United States. When a program of that size is projected to pay only 83% of scheduled benefits in 2034 absent reform, the problem is not theoretical. It is sitting on the national balance sheet in plain sight. Younger workers hear that and correctly understand the message. Your contribution is mandatory, but your outcome is conditional. Europe shows the same squeeze through a different set of institutions. Eurostat reported that the European Union's old age dependency ratio was 34.5% at the start of 2025. In simple terms, that means a little more than 3 working age adults for every person aged 65 or older. Long-run projections show that ratio rising sharply over the rest of the century. This is why pensions in Europe cannot be treated as just another welfare topic. In many continental European countries, public pensions are already one of the largest single categories of government spending. As the ratio worsens, pensions compete more directly with healthcare, long-term care, schools, defense, and infrastructure. Governments are not choosing between generosity and stinginess. They are choosing which promises get squeezed first. The countries under the most pressure are not random. According to the same OECD release, the working age population is projected to fall by more than 30% over the next 40 years in countries including Japan, Korea, Italy, Greece, Spain, Poland, and several Baltic states. That list matters because it combines aging with other vulnerabilities. Some of those countries already carry heavy public debt. Some already struggle with weak growth. Some are politically allergic to immigration or labor market reform. When fewer workers are producing income, paying tax, and funding retirees, even a well-intentioned system becomes harder to rescue. Demography is not a culture war slogan here. It is a budget constraint. The spending trend itself tells the story. According to OECD data, public spending on cash old age pensions and survivors benefits rose from an average of 7% of GDP in 2000 to 1% in the latest available year. OECD long-range projections then put average public pension spending at 8% of GDP in 2023 to 2024, rising to 0% by 2050 across the OECD countries with full projections. In the European Union, the projection was roughly 9% of GDP in 2023, rising to 9% in 2050 before stabilizing. Those are huge budget lines. A government can survive a bad year in one program. It struggles when one of the biggest commitments in the whole state keeps expanding because the population structure is shifting underneath it. And solvency is only half the problem. Adequacy is the other half. Even in systems that remain formally alive, the benefits may not be enough to preserve the lifestyle people imagine. OECD figures suggest that, on average, a full-career average wage worker entering the labor market today can expect a future net pension worth about 63% of net wages. In several countries, the figure is below 40% for full-career average earners. That is a brutal detail because many households do not mentally plan for a 37% or 60% income cut. They plan as if the public system will mostly carry them. Then they discover that a pension can be solvent, legal, and regular while still being too small to replace the life they were actually living. The pain is not evenly shared. Women get hit harder because the underlying career path is often less pension-friendly. OECD data show women's monthly pensions averaging about 23% lower than men's, with the deeper cause being lifetime earnings gaps of roughly 35% on average. Add more career interruptions for caregiving, lower private savings accumulation in some systems, and longer life expectancy, and the retirement gap widens again. The same is true for gig workers, contractors, migrants, informal workers, and anyone without employer-sponsored retirement coverage. Modern labor markets are fragmented, mobile, and unstable. A lot of pension systems were designed for long, stable careers with one employer or one clean tax record. The mismatch leaves millions exposed. There is another change hidden inside the retirement story, and it is one of the most important. The shift from defined benefit systems to defined contribution systems moved risk from institutions to individuals. In the older model, an employer or government carried more of the longevity risk and market risk. In the newer model, the worker carries far more of the danger. The worker bears investment risk, inflation risk, timing risk, and the risk of outliving the account. Two people can earn similar wages for decades and still retire into very different realities because one hit a market boom, one hit a crash, one paid lower fees, or one happened to reach retirement at a better moment. That does not feel like retirement security. It feels like retirement roulette. Access is another part of the crisis. The retirement gap is not caused only by weak returns. It is caused by millions of people not saving at all or not saving enough. A World Economic Forum commentary on the retirement gap emphasized that expanding access to retirement plans matters more than just boosting returns for people who are already saving. That is an uncomfortable point because it means the problem starts before portfolio theory. Plenty of households are not comparing funds or optimizing tax wrappers. They are entering their 50s and 60s with little or no defined contribution savings in the first place. The crisis is therefore macro and household level at the same time. Underfunded systems above, underprepared individuals below. That is why the slogan "Your generation will never retire" lands hardest on people under 40. They look up and see official funding stress. They look sideways and see housing costs eating the money that older generations used to save. They look at labor markets and see short contracts, gig work, and career resets. Then they look ahead and see longer life expectancy, which sounds positive until you ask who pays for those extra years. Living longer is a gift only if the years are financed. Otherwise, longer life can mean a longer period of financial insecurity in old age. The housing piece is especially cruel, even though it is not the headline in pension reports. Older retirement models quietly assumed a paid-off home by the time work ended. That made lower retirement income more manageable because the biggest monthly cost had shrunk. Younger workers in high-cost cities often face the opposite path: later home buying, heavier debt, or permanent renting. If public replacement rates are already around 63% on average and below 40% in some countries, trying to cover rent or a late mortgage inside retirement makes the squeeze much worse. The old pension promise did not just assume a check. It assumed a whole economic context that many younger workers do not share. So what happens if governments do nothing until the pressure peaks? The options are all politically painful, but none are mysterious. Governments can raise payroll taxes. They can cut benefits directly. They can raise the retirement age. They can means test benefits more aggressively. They can borrow and spread the bill into the future. They can encourage or force more private saving. In reality, countries usually mix several of these. The reason younger workers feel cynical is that every path asks them for more. Pay more now, work longer later, save more privately, and prepare for lower public support anyway. That is why the retirement debate no longer sounds like a promise. It sounds like a warning label. There are, however, systems that have bought themselves time. And that matters because this is not a universal collapse story. Countries that raised retirement ages, auto-enrolled workers, expanded funded pillars, or built strong occupational systems look more resilient than countries that simply hope demographics would behave. The United Kingdom's automatic enrollment policy is often cited because making retirement saving automatic materially raised participation. Denmark is often praised for giving citizens a more consolidated view of retirement assets, which makes planning less fragmented. Australia's compulsory superannuation system built much larger funded balances than many peer systems, even though it still does not solve every adequacy issue. The lesson is not that one country found a magic switch. The lesson is that design choices matter years before the crisis hits. That is also why the exact headline figure matters less than viewers think. Whether you call it 41 trillion, 70 trillion, 94 trillion, 24 trillion across selected systems, or 400 trillion by 2050 on one projection, the core message survives. Retirement systems are under pressure from aging, slower workforce growth, longer lives, and insufficient savings. A younger viewer should care less about winning an argument over one giant number and more about understanding the four smaller numbers shaping their own life. What share of income they save, how early they start, how much market risk they can really stomach, and how long they may need that money to last. The scariest version of this story is not zero. Zero is dramatic, but it is not the most realistic scenario in many rich democracies. The more realistic fear is haircut after haircut. Benefits that still arrive, but later. Checks that still come, but buy less. Retirement ages that move, then move again. Public systems that remain alive, but no longer preserve a middle-class standard of living without private savings doing much more of the work. That is how a generation can technically retire and still feel like the promise was broken. So if you hear a politician say the system is safe, because checks will still go out, listen for what is missing. Safe for whom? At what age? At what replacement rate? After how many tax increases? With what burden shifted back onto families? The old idea of retirement depended on millions of workers believing the system would do what it said on the tin. Official reports now tell a more complicated story. The retirement label may survive. The retirement experience is what is changing, and that is the real reason your generation feels like it will never retire. Not because every pension becomes zero, and not because every country collapses at once, but because the old retirement model is being slowly redesigned by demography, politics, and undersaving. If you want the follow-up episode on which reforms actually work, watch the next video, because the countries buying themselves time are using tools that younger workers cannot afford to ignore. 1. Reason this subject becomes emotionally explosive is that public pension systems do not fail like startups. They erode in slow motion. A trust fund depletion date like 2034 in the United States does not trigger a dramatic shutoff switch. It triggers a permanent gap between what was scheduled and what can be paid under current law. The 2026 trustees projected 83% of scheduled benefits payable for the combined funds and 78% for the old age fund at late 2032. Those percentages are politically useful because they sound survivable. They are also personally devastating because a 17% or 22% cut lands on people who plan for 100%. A household can absorb a bad restaurant bill. It cannot casually absorb a fifth of retirement income disappearing. That slow motion quality is why younger workers often misread the danger. They hear that the system will not go to zero and assume the crisis is exaggerated. But a pension promise does not have to vanish to fail its social purpose. If retirement ages keep rising, if replacement rates stay weak, and if housing and health costs keep climbing, then a system can remain solvent while producing a much poorer old age. The label retirement survives. The lived experience changes. That is how a legal promise turns into an economic disappointment. The pressure also spills beyond pensions into the wider care economy. OECD and Eurostat dependency ratios are not just pension charts. More people over 65 means more pressure on health systems and long-term care systems at the same time that pension spending rises. In the European Union, public pension spending is projected around 10.9% of GDP by 2050, but pension pressure does not arrive alone. Older populations need more medical care, more formal care workers, and more family support. A smaller working age base is therefore financing several aging-related systems at once. That is why governments cannot fix pensions in isolation. The same tax base is already being asked to support health and care too. For younger adults, one hidden consequence is the rise of intergenerational squeeze. An adult in their 30s or 40s may be trying to fund rent or a mortgage, save privately because public systems look less generous, and help older parents whose pension or savings are not enough. In that scenario, retirement insecurity is no longer something that begins at age 65. It begins decades earlier through transfers within families. The social model shifts from the state carrying most old age risk to families carrying more of it informally. The gender gap makes that family burden even more important. If women's monthly pensions average about 23% lower than men's, and lifetime earnings gaps average about 35%, then widowhood, divorce, and solo old age become much more financially dangerous. A pension system can look stable on aggregate tables while producing very unequal outcomes once real careers are considered. This is one reason averages can mislead. A national replacement rate around 63% does not tell you what happens after interrupted work histories, years spent caregiving, or long stretches outside formal employer plans. The households most exposed are often the ones least visible in the headline numbers. Gig work deepens the same pattern. A pension design built around stable full-time employment struggles when more workers move between contracts, platforms, freelance projects, or cross-border jobs. Contributions become irregular. Employer matching may vanish. Record-keeping fragments. Private saving is easier to postpone when income itself is unpredictable. That matters because access, not just return, is one of the biggest issues behind the retirement gap. A worker outside the system for 10 or 15 years does not mainly suffer from choosing the wrong fund. They suffer from not being integrated into regular saving at all. This is where the countries that bought time become so interesting. Automatic enrollment in the United Kingdom mattered not because it solved aging, but because it changed participation behavior. Australia's compulsory superannuation mattered not because markets are always kind, but because forcing contributions over long periods creates funded balances that many voluntary systems never achieve. Denmark's more consolidated retirement view mattered because people cannot plan around assets they cannot even see clearly. These are unglamorous reforms. None of them generate movie trailer excitement. But each one attacks a practical weakness that shows up in the retirement gap. Low participation, weak visibility, or over-reliance on future political rescue. Another reason the old model is disappearing is longevity risk. In defined contribution systems, living longer creates a strange double-edged problem. A longer life is good news from a human perspective, but it means the same pot of savings must stretch over more years. If inflation stays persistent or health costs rise late in life, the problem gets worse. An individual saver now has to manage asset allocation, withdrawal rates, sequence of returns risk, and the possibility of outliving the account. In older defined benefit systems, much more of that complexity sat with institutions. The shift transferred not just risk, but also planning difficulty onto people who were never trained to manage it. And this is why younger viewers should ignore the culture war distraction that often hijacks this topic. The core problem is arithmetic before it is ideology. a ratio that moves from 22 people aged 65 and over per 100 working age adults in 2000 to 33 in 2025, and then 52 by 2050 is an arithmetic event. A working age population falling by more than 30% over 40 years in countries like Japan, Italy, Spain, Korea, Greece, Poland, and several Baltic states is an arithmetic event. Public pension spending rising from 7% of GDP in 2000 to 1% in the latest year, and heading toward 0% by 2050 is an arithmetic event. Politics changes how the burden is distributed, but it cannot erase the burden itself. So the fairest reading of the retirement crisis is brutally simple. The exact trillion-dollar estimate changes with methodology. The demographic direction does not. The policy menu is limited. The burden will be shared somehow, but not gently. And the people most at risk are the ones still assuming that a 20th century retirement script will still be waiting for them untouched. It will not. The sooner younger workers treat public pensions as one layer rather than the whole plan, the less shocking the next 20 years will feel.